The thing I'm more interested in is the ultimate end game of this cycle. It's where do we go from here now that we're in uncharted territory, as it were. And if you look at the previous bull markets in gold, and I count only three: the early 70s, the late 70s, and the early 2000s. In each of those instances, the price of gold went up between 5.6 and 8.2 times. So if you look at the low for this cycle being around $1,040, then you're looking at anywhere from $6,000 to $8,000 gold when we get to the end of this cycle.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Gold's been one of the best performing assets of 2024 so far. It's up over 30% since the start of the year, and it recently hit a record high. Now, with the central banks of the world's largest economies, the US, China, and the EU, now all cutting interest rates, will that add further fuel to gold's breakout? Well, for answers to all things gold, silver, and the companies that mine them, we're fortunate to speak with Brien Lundin, CEO of Jefferson Financial, publisher of goldnewsletter.com, and producer of the excellent New Orleans Investment Conference. Brien, thanks so much for joining us today.
Great to be with you as always, Adam. Thanks so much.
All right. Well, look, we'll get to this at the end of the conversation, but I mentioned there in the intro that you produced the excellent New Orleans Investment Conference. That's coming up just next month, and I believe this year is your 50th anniversary of doing it, correct?
Yeah, it is the 50th anniversary of the event. It's only 38 years for me with the event. Still, somewhat of a newbie there, but yeah, it is the world's oldest investment event, longest running.
All right. Well, great job on carrying the torch and carrying it for 38 of those 50 years. And I can't wait to be there this year at the 50th. And again, we'll talk about the specifics of that, folks, in a little bit, if that's something you're interested in attending as well. Brien, got a lot of questions for you, obviously about gold. You're Mr. Gold here and gold miners. Before we get into the precious metals, though, let's just start with the general question I like to kick these discussions off with. What's your current assessment of the global economy and financial markets?
Yeah, Adam, I think what we're seeing here, and particularly as it relates to gold, is people are recognizing, when I say people, I'm talking about investors around the world, from institutions, family offices, hedge funds, et cetera, anyone with a significant stake in the markets. They are positioning for really two things. One, more immediately, the Fed pivot and central banks in general switching from what was arguably the harshest rate hiking environment ever to the other side of the cycle, to cutting rates, to easing money. And that is the immediate concern, the immediate big event that's moving everything. Longer term, I think that these investors, these actors in the market, are looking at the 40-plus year trend of ever easier money that's now continuing. And they're looking at the massive debts that trend has encouraged over that time frame, to the point now where it's you cannot service those debts with interest rates that are anything approaching normal levels. So that's become a strain on governments in the U.S. in particular. We've seen the cost of servicing the federal debt exceed $1 trillion, and it's still rising even as the Fed is cutting rates because of so many resets still in the system. So the end result of all that is we can't have positive real rates, interest rates that are higher than the rate at which the debt is being depreciated going forward for any significant period of time. And that constraint, the fact that we're going to have negative real rates going forward, is bullish and positive for things, for obviously the monetary metals like gold and silver, but also commodities in general, real estate, tangible assets. And it's all part of the tectonic shift from financial assets toward commodities and more physical assets going forward, I believe. So I think we're seeing the early stages of repositioning globally for that. And it's not anything like a big AI-driven mania or anything like that. It's just the allocation shift in allocations, gradual small shifts in allocations on a percentage basis towards things like gold, silver, commodities. But these markets are so much smaller relative to the financial markets that a little bit goes a long way, makes an outsized difference in those markets. And that's what we're seeing right now. And I think that's what we're going to see really for the foreseeable future.
Okay, so it's largely driven by policy,
Mhm.
which is, basically you think central banks are going to have to work harder going forward to keep real interest rates negative, and that is beneficial. I hate to use that word, but at least nominally beneficial to the prices of hard assets, as you mentioned here. As you talk about sort of more and more investors waking up to these concerns and saying, you know what, they're going to just have to keep crushing real interest rates going forward. I got to get myself some gold and some other hard assets. What kind of curve would you draw out from here? Is this just a linear where it's a little bit more every year being allocated this way, or is it more of an exponential curve? Sorry, I should have done this way, linear that way, or is it more of an exponential curve where, more and more folks do it and it starts to sort of snowball on itself? There's some inflection point in there.
Yeah, I don't think, well, not so obviously, I guess, we haven't gotten to the exponential part of it. But if you look at the numbers, we're up over almost 7% on the gold price this month over the past 30 days, at least as we begin October when we talk. And year to date, about 39%. So this is one of the best years and one of the best early stages of a bull market that we've ever seen in gold. And that's, going back to the 1970s. So, yeah, we will continue to rise, I think. And that's because when you see a shift in policy like this, it's something that's going to last for a long time. What's key now is that the Western investors are just getting involved in this bull market. They've just started coming into gold really around the 1st of July. That's the first time we started to see the GLD ETF, gold ETF, actually have inflows, significant inflows. And that's really a proxy for Western investors. So they started coming in to price in the pivot. And now that we've had that big shift in policy, they're coming in more so. Before that, you mentioned central banks and Chinese investors were buying, and that was what was driving that portion, that early stages of the bull market. That was just a straight line rise with very few price breaks. That's not going to happen going forward. When you get Western investors involved, they're more speculative in nature. So they're going to overshoot, come back, have a correction, digest those gains. Then you're going to have another rally. So we're going to see a lot of wiggles in the line going forward, but I think very confident it will still be an uptrend, a significant uptrend. But we'll have those pullbacks that will test people's convictions and try and wipe out the weak hands in the market.
Okay. All right. You gave me a lot of material to dig into there. So you and I have talked, well, you and I have known each other for better part of a decade or so, Brien, but we've talked in past years in these interviews about the state of gold. And I mean, you remember back when Grant Williams published that well-circulated report, Gold, Nobody Cares, right? And it seems like over the past couple of years, different parties have increasingly started to care about gold, right? Central banks have been a big one. They've increased their gold buying to, I believe, record levels over the past couple of years. As you mentioned, Chinese investors have really gotten big into it, and I'm sure other Asian investors as well, but largely the Chinese. And that really up until quite recently, the Western investor hasn't really been in the game.
Yeah.
And I just interviewed video before this one, Brien, or two videos before this one. I interviewed Jan van Eck, whose company has a lot of ETFs that invest in the precious metal space. Here's a chart that he showed me that I think tells a really interesting story here. One, the bar chart on the right shows you the increase in gold as a percent of total reserves for big regions around the world: China, emerging markets, and developed markets. And you can see here that certainly China and the emerging markets are increasingly increasing their percentage exposure to gold, where actually the developed markets have as well, if you compare it to the beginning of the millennia. So everybody is still loading up. The chart on the left here shows China ETF holdings, which is kind of a proxy for the Chinese investor, and Western ETF holdings of gold. And you'll see here that, since basically, right before COVID started, the Western ETF holdings have gone down pretty substantially, whereas recently the Chinese holdings have just skyrocketed. So this is validation of what you've been saying here, Brien, but you said, hey, the Western investor just started getting involved in July. I can't tell you exactly where this chart ends in 2024, but it doesn't look like it's really moved up all that much. So my point is we still have a long way to go for the awakening of the Western investor. And given how relatively small this market is compared to others, what impact do you expect that to have on the margin when the West, if the West does wake up to this? Because Wall Street for many years hasn't cared, as Grant said. But one thing Wall Street likes to do is make money, and when it sees momentum, it loves to chase it. So what impact will that awakening of the Western investor have if it indeed does happen?
Yeah, a big impact, because that's a lot of fuel for the market. We had expected the Western investors to come in early this year. If you remember back in December, the market was pricing in 5 or 6 Fed rate cuts for 2024, and it kept getting pushed further and further back. Given that kind of environment, with the Fed not having to cut rates, the Fed pivot being postponed ever further back in the calendar, you would have expected the gold price to lose at least a couple $100 from January on. But instead, it gained 200, 300, 400. It has been on an amazing run. And so all of that, as you showed, was due to central banks, Chinese central bank, People's Bank of China, largely, but central banks in general buying, and the Chinese savers / investors buying, because they really didn't have any other choice. The stock market was down, the real estate market was down. Gold was something that was moving up, and they invested in it. So that's where those ETF holdings went up, and that's where we saw the central bank reserves going up. So when the Western investors started to price in the pivot about midsummer, the gold price was already at a level that was $300 to even $400 higher than when we had expected the Western investors to come in. So we were that much more ahead of the game. So going forward, we are going to see a lot of buying, because we have a lot of room to make up in the Western ETFs, as you just showed. But concurrently, we've seen the large speculators, a hedge fund positioning in the COMEX futures and options, get to really overbought levels. So we have some tension there, in that the large commercials are very short, the large speculators are very long, and almost always the large commercials win that battle. They orchestrate some sort of a price drop that then flushes out all the large speculators. Occasionally, the large commercials get caught in a short squeeze. They're not very wrong. They're not wrong very often, but when they are spectacularly so. So we could see that. But my call at the moment is that we're going to see, I don't think a significant downdraft in the gold price, but a bit of sideways action for a week or 2 or maybe 3.
Okay, and I was working my way up to this question, so thanks for answering it. But it looks like you see decent odds of a short-term flatlining, or maybe even a short-term correction in the price of gold, because it's gotten short-term overbought, and because the big players are so positioned short right now, right? Let's say that does come to pass. Brian, and that washes out here, and we're now in November, December, whatever. Where do you see the price of gold heading as we go into 2025? Has it already made the majority of the move you expect that it's going to make in the relatively near to midterm, or is the action just getting warmed up here?
Yeah, I don't know. I've been in this business a long time, and you know that you're not supposed to give a price and a time frame,
Right.
one or the other. We may not have a 39% rise in the gold price going forward, absent some sort of a major economic financial crisis situation, and not certainly not going to rule that out. But at these price levels, if you're looking at a 10% rise, you're talking about another $270 to the gold price. If you're talking about a 20% rise, which is very typical in gold bull markets, you're talking about another $500 on the gold price, and you're talking over $3,000 gold. Now that would be pretty good we would hope, for the mining stocks. So that would be a sizable run, and certainly something that's within the realm of possibility given these numbers. The thing I'm more interested in is the ultimate end game of this cycle. It's where do we go from here now that we're in uncharted territory, as it were. And if you look at the previous bull markets in gold, and I count only three: the early 70s, the late 70s, and the early 2000s. In each of those instances, the price of gold went up between 5.6 and 8.2 times. So if you look at the low for this cycle being around $1,040, then you're looking at anywhere from $6,000 to $8,000 gold when we get to the end of this cycle. That is something I think we're going to get to. I think the record shows that's where we're going to go. Now, is that going to be in a couple of years? Is that going to be in 5, 6 years, or even 10 years? Nobody knows. And anybody who tells you they know is probably lying to you about something else. But that is the trend. And I think all we can do as investors is recognize the trend and invest accordingly.
Okay. All right. I think you just got some people's attention there with $6,000 to $8,000 gold. Hey, I appreciate the fact that you are painting with a broad brush. And I very much agree that you don't want to hang a date on that, but you feel like if this cycle plays out like past ones, at the end of the cycle, whenever that manifests, we could be in that kind of trajectory. Okay, so I want to get to silver and to the miners in just a moment, because both of those this time, so far in the cycle at least, have not performed the way they historically do when gold makes a run like this. And I know a lot of people are scratching their heads about that. And I'm guessing you're going to say they may offer a lot of potential opportunity here right now, kind of get into these things before they catch up to their historic ratios. But I'll let you answer that in just a minute. Is there anything else about just sort of the fundamentals of gold that we haven't put on the table yet that you think is worth, noting for the viewers here?
Yeah, I think one of the things that lead people least to hesitation on investors in buying gold at these levels, and I can completely understand it. It's up almost 40% over the past year. It's setting new records almost every day. May not seem like the time to buy. And truthfully, if you're looking at investing in the physical metals, especially gold, it probably isn't. But there are two reasons to buy gold: to invest and to insure. And right now, if you feel that if you don't hold a significant portion of your wealth in physical metals, physical gold and silver, and you look forward 3, 5, 8, 10 years, and if you're confident that at that point your currency, or the dollar in many people's cases, is going to be purchasing much less than it is today, you can lock in today's purchasing power of the dollar by buying physical gold and silver, because over long time frames, long sweeps of history, gold has never failed to protect purchasing power. And that's proven over decades and decades. So you can buy metal right now, buy gold to ensure a portion of your wealth against this depreciation of the currency, which you know is going to happen. The other thing is, if you think that the price of gold is going to rise significantly from here, you can then invest in the sector and find ways to leverage that trend. Not necessarily gold itself, but as we're going to talk to about in a minute, the mining stocks. There are other ways to leverage the metals. There are ETFs that offer leverage, and silver itself offers leverage to gold.
Okay, so there's some practical questions that people ask me all the time about buying, storing precious metals. Folks, I have a kind of a basic primer on that I'm going to be releasing soon, just to help answer a lot of those questions. But let me ask you one around that, Brien, which is, I believe you, correct me if I'm wrong, but I believe you would say, hey, look, you want to own some precious metals physically and literally have them available to you on short demand, right? Either in your home or somewhere local where you can get on that. And that's kind of almost like your Armageddon insurance. I don't think you think that is the probable high probability outcome here, but that just if we ended up having some sort of currency crisis that captured everybody by surprise, which has happened at times throughout history, not very often, a little bit of precious metals can go a long way. So you want to have some that you can kind of get in your hot little hands, like I said, on demand. Beyond that, you might want to still own some more physical, but you don't want to have too much of it, on your person, because it becomes a safety or a loss or a theft risk. And so you might want to have that stored for you, hopefully in an allocated version, meaning in your name.
Yeah.
And then if you want to invest beyond that, where you're really more investing / speculating on where the price may go, but it's not your Armageddon insurance, then you want to get into the more sort of paper aspects, whether it's the miners, whether it's the ETFs, et cetera. In your mind, how does somebody determine how much physical they should keep close versus say, I have enough and I want to start allocating more, to these other forms?
Yeah, the classic answer to that is, at what point do you sleep well at night?
Okay.
That you have that. More quantitatively, physical metals, just investing in gold itself, if you look at modern portfolio theory and all of that, the numbers show somewhere between 5 and 10% of your portfolio, your investment portfolio, helps you reach that efficient frontier of the highest risk-adjusted return. But yeah, whatever makes you sleep well at night, and if you look at preserving your wealth in general, whatever you have outside of physical assets, like your real estate, et cetera, things that won't necessarily appreciate as the dollar depreciates, you want to hedge that probably around the same ratios, 5 to 10%. Some people go much larger than that, but then to do that, if it's a part of the investment portfolio, you're sacrificing opportunity as well. So if it's that insurance, probably 5 to 10%.
Okay. All right. Sorry, you're making me think of a comment that Rick Rule has made several times when I've talked to him, where he says, I think historically, when you look at, I guess we'll say sort of professional capital managers, I think the ratio that their portfolios were invested in gold was like historically, I think around 2%, something like that. I may be remembering wrong, but I think it was around 2%. And I think right now he's saying the current average is like 0.5%. So
yeah, it has peaked at around 4% during bull markets, or the average in a bull market, and it's about 1/4 of where it would be in a right now in a bull market. But the key here is that this, it's hard to say this time is different, but there are different aspects to this market to any other one we've ever had. One is there's just so much money sloshing around the world. There's so much capital looking for a home. And this is after, again, decades of ever easier money. And a good portion, if not the majority of that money, has very little allocation toward gold or silver or the mining sector. So if you get just a very small shift, and I think that's what's happening right now, we're seeing allocations in big portfolios, big holdings around the world shift from maybe 0 to 0.5%, or maybe from 1% to 2%. And cumulatively, that's an awful lot of money. And it's especially an awful lot of money for a relatively tiny market like gold, and then the tinier markets of silver and tinier markets of mining stocks. So the leverage there from these very small shifts in allocations around the world into these relatively small sectors makes a dramatic difference to valuations. And I think that's what we're seeing right now.
Okay, well, I'm just about to get to silver and the miners, but remaining on gold just for a moment. So two things. One, I just feel like we need to be crystal clear with folks that the precious metals, like many commodities, are volatile. And so, when you buy in, be prepared to see the number change a lot. And so, if you're somebody who buys in, you're buying in for safety reasons, then the price goes down. If you're one of the people who just panics and sells, know that about yourself before you go into a volatile asset like this. So I believe that in the trends that you're talking about here, Brien. I'm just curious. One of the things that's different about this time is at past times in history. So, like, let's go back to the Weimar Republic, right? There were other currencies that you could kind of hide in if you didn't like what your country was doing with its currency. We're sort of in this, in a different world now, where all major world fiat currencies, pretty much all world currencies, just in general, are fiat based, meaning they're unbacked. And so, what we're seeing here is everybody is, for the most part, using the same playbook, right? Everybody's increasing their money supply. They're printing more over time. So you don't really have the opportunity to hide out in another currency the way that you did at previous eras. Maybe the one thing that's different about this time versus past is we do have assets like Bitcoin, where some people say, well, that's being created to be like the even better preserver of purchasing power, because it's a fixed number. Like, unlike the gold supply, which has constraints, you still mine new ore, new gold every year. But Bitcoin is, in their eyes, perhaps an even superior alternative. Not necessarily asking for you to make a qualitative comment about Bitcoin, but that trend you talked about of money leaving these other assets for the safety of those that can't be inflated away. How much, if any, of what you think should go to gold might get stolen by Bitcoin and other cryptos?
Yeah, I think a good bit of it already has, but I think it's mostly been in the speculative area. Speculative demand has been stolen to some degree, by Bitcoin and other ways of leveraging gold itself. We have 2x gold ETFs, both in stocks and in metal, the metal and the mining stocks. We have people who have the ability to buy options and leverage. So there's a lot of ways to get leverage on the metals. And from a speculative aspect, I think that's primarily where Bitcoin has stolen the thunder somewhat from gold. But as far as a safe haven, I don't think that aspect of Bitcoin has been proven. It's been projected endlessly, but I don't think it's been proven yet by any means. And you see gold as one of those safe havens. Now, interestingly, you see the dollar in some cases also as a safe haven. And that gets back to the point that you're talking about. I'm a little different than a lot of the other gold bugs or people in the gold industry out there, and that I don't necessarily believe that the dollar is going to crash. and that's going to launch gold. I think over the long term, all fiat currencies are going to lose credibility with the public because of what we're seeing of repeated cycles where there is some kind of a hiccup or recession or financial crisis, and then the central banks come in and alleviate the pain and rescue the markets. And they do that through ever greater applications of monetary and fiscal policy. So there's a huge avalanche of new money created with every one of these crises. So how many of these crises do we see before it gets ingrained in the public's mind that there's going to be another crisis and there's going to be a whole lot more of my currency created when that happens? So with each step, with each one of those steps, each one of those cycles, the currencies lose some of their credibility. Eventually, the only way to restore that credibility is to establish some sort of a link to an asset that's out of government's hands, that handicaps them somewhat. And I think the natural choice for that will be gold. So that's why I think the end game of this will involve gold at some point.
Okay.
That's why you need to know it. You need to own it today.
And Brian, is that kind of essentially happening right now with the central bank gold buying, where your dollar's backed in your full faith and trust of the government, but here is the central bank basically saying, we're looking for quality assets to put on our balance sheet, and therefore, we're choosing gold right now, right? I mean, I know it's not as obviously direct as it was back when we were on a gold standard, but can you look at the central banks buying gold essentially as a move towards what you're talking about?
I don't think so, because it's not an anti-fiat move, because every central banker thinks their currency is just fine. But it's an anti-dollar move. If you look at that rise in central bank gold purchases, it was not coincidentally begun right after Russia invaded Ukraine, and the US and the other Western nations enacted those severe sanctions that essentially locked Russia out of the dollar economy, global economy. So at that point, central banks started to get a little nervous and started to buy gold and move from the dollar to gold. Now, those lines haven't crossed. The dollar is by far the dominant reserve currency in central bank balance sheets. But gold has just passed up the euro as the second place asset on central bank balance sheets. So the percentage of gold held by central banks as a reserve asset is rising, and the percentage held of the dollar held by central banks is falling.
Wow, that's an important milestone that it just supplanted the euro and is now number two in central bank assets. Okay, right. Look, let's now get to where I'm sure folks have been waiting for, is your thoughts on silver and your thoughts on the miners. Real quick, the miners are looked at as a leveraged play on the price of gold, and that's relatively easy to understand because you can think about, if gold is a hot commodity, these guys are the guys that have the printing press. They're out there and they're making more of it, right? So it's that ability to keep making more gold, producing more gold, that gives them this leverage. Why does silver tend to be a levered play on gold as well?
Well, it's a monetary metal. It's one of, I think, only two monetary metals. It has a history as money, like gold, and it's a lot cheaper than gold. So historically, when in every one of these bull markets in gold, we've seen silver outperform gold. It always has provided leverage to gold's moves. Now, that's to the downside as well as to the upside, so it's much more volatile. But interestingly, it really hasn't moved yet like we would have thought it would have in this gold bull market. It has, on occasion, leveraged the moves in gold, and in particular, over the last month or two, we've seen some really significant rises in silver, where the gold-silver ratio is generally fallen, meaning that silver is outperforming gold. So that's been somewhat helpful. It's also a validation of a gold bull market. And the mining stocks, they've similarly performed. They have on occasion outperformed gold and they really started to kick in more over the last couple of weeks.
Okay, so let's go short term, let's go long term. What do you expect silver to do in the near term? And by near term, let's say next couple of quarters. Do you expect, a catch-up move in silver to gold, just to maybe more historic gold silver ratio levels? And then if we were to hit $6,000 to $8,000 gold, what do you think that would equate to for silver prices?
Yeah, silver is, as I say, will always outperform gold, and that means the gold-silver ratio will continue to fall. So if we see gold going to $6,000 to $8,000, that's a doubling to nearly a tripling of the gold price from here, and you would generally see silver perform significantly better than that. So silver would go up 200 or 300%, or 2 or 3 times itself, or a little bit more. So if silver is about 30 something dollars right now, you're probably looking somewhere over $100 for silver if you see a doubling of the gold price from here.
Okay, all right. And then just looking at the next couple of quarters or so, again, do you sort of expect silver to play a little bit of a catch up here, or are there material forces that you think might still keep it constrained?
No, I don't think there's anything that's really going to keep it constrained. Have never been a big believer in the industrial story for silver. Silver's industrial usages. I think its primary function has been as a stick to beat the market over the head with whenever there's anything that points to an economic slowdown or China's slowing down or something. Traders will look at that and say, well, we're going to slam copper, and oh, silver's industrial as well. We'll slam it. Silver's value right now is almost completely due to its monetary history. Its price is almost due to its monetary history. Now, that said, the forecasts for silver usage going forward are such that there are going to be tremendous demands on it from an industrial basis. The solar demand for silver alone is projected to take up all of the annual mined silver production by 2030. So even if you cut back those projections significantly, you see that it's going to have a big effect on silver and pull a lot of it off the market. And now they're coming out with batteries that have silver in the chemistry that look to outperform lithium-ion batteries, and that could steal a good bit of the annual production for silver. So I think that's a story that really has not been important, but 3, 4, 5 years down the road, it's going to be important.
Okay, and I think it's worth really helping folks understand here that pretty much almost every ounce of gold that's been mined is kind of still with us somewhere above ground, painting with a broad brush. But it's, in storage, yes, or it's in jewelry or things like that, but it's still here, right? Where silver does get used commercially. And as you mentioned, a lot of mine production gets used commercially, and that commercial production is increasingly taking up a greater and greater percentage of the annual mine supply. So I guess where I'm going with this is, if we're in danger of 100% of silver mine supply being used commercially by 2030, and most of those commercial uses they're not recyclable, that silver is not recovered. One, that makes the above ground silver market tiny compared to gold, right? And then the fact, if we get into, can we get into danger of actual shortages of silver, both for commercial uses, but also just for investors that want to be investing in it?
Well, I look at it from the standpoint of not so much shortages, but price rises. Shortage is solved by price, and vice versa. So yeah, the price will rise to the degree that they'll go out and reactivate old mines, they'll start to recycle, et cetera, et cetera. But in the meantime, those who invest in silver are going to have a good time. They're going to enjoy those price gains. Now, the thing about gold, that every bit of gold is above the ground and it really doesn't have industrial usages, that is on one hand can be perceived as a negative, but consider it from this standpoint. If in fact we do have to reattach fiat currencies or the dollar back to gold to reestablish some credibility of the public for that currency or currencies in general, then that would demand a significant increase in the gold price. So you would have to, for instance, just to cover 20% of M2 in the US, you'd have to have a $10,000 price of gold. And that's just a fractional coverage of the currency or backing of the dollar. Gold is the only element on Earth that can be used in that fashion. In other words, it is the only element out there that you could double, triple, or quadruple its cost in a flash and not upset any industry in the world today.
Mm-hmm.
Because so little of it is used in any application. If it was double or triple or quadruple the price, it would have very little effect on the price of that asset. The exception, of course, is jewelry, and jewelers know how to compensate with alloys, lowering the carat content, raising the price, etc. So gold is, imagine that, the perfect thing to use as money, and it's there and it doesn't go anywhere. So it is the perfect vehicle to use as money and to back currencies.
Okay. I could keep drilling down here, but we got to move on. I definitely want to make sure we touch on the miners here. So sounds like with silver, you're saying good time to get in if you don't have a lot of exposure to silver, because the dynamics you just mentioned should be tailwinds at your back going forward from here. Miners, let's talk about the space and talk about why you think they haven't kept pace with gold this time. And are they similar good values lying there, awaiting today's investors?
Yeah, there are some extraordinary values there. They have not moved yet for a number of reasons. Primarily what we've just talked about, that Western investors have not been involved until very recently in the metals and mining market. The central banks don't buy gold miners. Chinese investors and savers don't buy gold miners, gold stocks. But Western investors do. And they do once they bought the metal itself, once they've leveraged their metal holdings, and then they're looking for ways to leverage the trend and to get more torque out of the trend. And then they start buying the senior gold producers. And then they work their way down the food chain, or they always have in the past worked their way down the food chain towards the intermediate producers, the junior exploration development companies. Right now, with these kinds of margins, I mean, even the worst miner out there has over 50% margins right now on their product. Gold mining companies are renowned as being among the worst stewards of shareholder capital. They spend like drunken sailors in a bull market. They buy depreciating assets. They make mistakes. But in this kind of a market, they are, as you mentioned, they are literally digging money out of the ground, and they're spinning out tremendous cash flows that just now Wall Street and generalist investors are starting to notice. So it's starting, we're starting to see the GDX and GDXJ, big gold mining ETFs, start to outperform gold in fits and starts. And I think it's going to continue with each quarter as those quarterly financials are released. And generalist investors see the kind of money that's being spun out by these gold mining companies.
Okay, so we're recording this discussion in early October, so earnings will be coming up relatively soon. Do you expect there to be like a pretty big attention shift on the miners now, because they're now coming off a quarter where they've had the highest gold prices they've ever had, right?
Yeah, I expect that, and we have seen that to some degree. We've seen the values increase. the share prices increase as they get more attention, and it's going to continue because, you know, I put out something about a month ago saying $2,500 gold changes everything. The miner margins are incredible. We've seen, generally speaking, the price of oil, the price of energy, which is such a huge component of operating expenses for a gold miner, fall while the gold price was surging. So $2,500 gold provided just tremendous margins for the miners. Well, now we're talking $2,600 gold. Actually, no, we're talking $2,700 gold. So no matter how badly run these miners were 3 months ago, or 1 quarter ago, or 2 quarters ago, they are so well in the money right now that you know, they're putting out the kinds of returns, the kinds of cash flow that simply cannot be ignored by the market.
Okay. You mentioned a piece that you put out. You publish one of the most widely read and respected newsletters on the gold mining industry. And in just a moment, I'll give you a chance to tell folks where they can learn more about that and maybe sign up if they want to. So we're talking about the metal gold, the metal silver, and the mining companies right here. When we look at this whole space, where do you see the biggest opportunity for investors right now?
I think there's a couple of places. There are companies, these junior companies that have found, identified, drilled off, and in some cases have economics wrapped around really large gold deposits. And some of these deposits were positioned as a business model as out of the money, not economic at current gold prices, a really highly leveraged play on rising gold prices. Every one of those projects that were, as of this time last year, out of the money, not economic at current gold price levels, are now not only economic, but wildly so. Yet their share prices, by and large, have decreased since then. So that's a huge opportunity, I think, for investors. Another one that offers a lot of upside potential right now is we've talked about, you know, silver offering natural leverage to gold. Well, silver producers and silver explorers and developers offer leverage to silver itself. So you can add leverage on top of leverage by buying junior silver miners and explorers and developers and producers as well at current prices.
Okay, this is the point of the conversation where I'm going to reinsert the fact that not only are the precious metals themselves volatile, but the mining companies are much more volatile than the metals, and the junior mining companies are much more volatile than the senior mining company.
Very important point, that it is an area where you need to educate yourself and be able to sustain that kind of volatility.
And so if you're watching and you're not yet very experienced in investing in this sector, a great way to both educate yourself, and if you want to start getting exposure before you feel you've become, you know, really smart in this space, highly recommend that you follow experts who do nothing but follow this space, talk to management. Some of them even go out and visit the mines. Brien, I know that you're one of the most connected guys in the mining industry in terms of your relationships with all the executive management teams of so many of these companies. And I know that not just from following you in your newsletter, but also going to your conference and actually seeing all these people there and you making introductions between them and investors. So for folks that are thinking, okay, well, maybe I want to take a look at Brien's newsletter because I'm interested in this space. Tell them real quick what they can expect in the newsletter and where should they go?
Yeah, goldnewsletter.com, and you can actually sign up for a free report, Investor's Guide to Gold and Silver. It is a 40-page primer on investing in the sector from physical metals to mining stocks. So that's a very valuable tool, and it's for free at goldnewsletter.com.
Okay, and in the newsletter itself, you not only track important things that are going on with the metals, but more importantly, you're looking at these mining companies and telling you basically have a watch list. You will tell people when companies do things that you like, when companies do things that you don't like, and you might take them off your list. This is a way of essentially for people to peer over your shoulder, correct?
Yeah, absolutely. We cover macroeconomics, metals, and miners, and kind of drill down and cover a number of companies in our portfolio that we think are going to make a lot of money for our readers in a relatively short amount of time in this sector. It is a much more speculative and higher risk uh, area of a sector that already is fairly volatile. But it in this kind of a market environment, it can be very rewarding.
Okay, I'm just going to put in my regular pitch, folks, too, especially for an asset class that's this volatile and has the uncertainty that this sector has in it. That if you're not an experienced investor in it, that not only do you follow the guidance of a good expert, but also work under the guidance of your professional financial advisor to determine what's a reasonable percentage of your portfolio to put in this. And maybe once you take positions, do you want to put any hedges in place? That type of things. Those are where a good professional financial advisor can really help. The ones that I have on this channel are very experienced in that, particularly the guys at New Harbor Financial. All right, so talking about macro, metals, and miners, I'm now thinking about your upcoming conference, and I want to give you a chance to tell folks what to expect there, especially given that it's the 50th anniversary. So I'm sure you're going to be putting on a really big show this year. I guess I should just say it's not just macro metals and miners. There's a lot of other investments that get talked about there. Certainly, the whole scope of hard assets are featured there, but you have a lot of people that focus on other elements as well. So, what's the quick elevator pitch about what you're doing this year and why interested folks here might really enjoy going?
Yeah, it's always a highly rewarding event, so much so that we have a money back guarantee. If you don't feel it's worth every penny, we give you your entire registration fee back. That's how confident we are in the value. We always bring in the top thinkers in economics, the markets, individual sectors around today, as evidenced by the fact that you're coming this year for our big 50th anniversary. So our roster is led off by Adam Taggart, and it includes people like Jim Grant, Brent Johnson. Obviously, I'm reading these off here. Dave Collum, Danielle DiMartino Booth, James Lavish, George Gammon, Jim Iorio, Jim Bianco, Lawrence Lepard, Rick Rule, Peter Bookvar, a lot of people that would be, obviously your viewers your followers have seen on your channel. We have them all here in one place at one time, and it is an extraordinary event to experience. You really have to experience it to really understand it. But the intellectual energy that you get from the stage, but also from your fellow attendees, is really quite extraordinary. Everybody has great ideas, and they're willing to share them. And it's not just the 50th anniversary, it's a rollicking bull market in metals and miners. And if there's one thing that's been proven over decades, is that in this kind of an environment, with an uncertain future, more uncertain than normal, but with the metals and the mining stocks taking off, the New Orleans conference is really the place to be.
All right. Well, first off, let me tell folks where to go if they want to learn more about it. Go to neworleansconference.com/TM1. That's TM numeral 1 for those of you who are listening. I think I've been pretty much almost every year of the past 10 years. I'm really looking forward to going this year. One, because it's the big 50 and shindig. Also, two, it's going to be fun to be there in a year, as you said, where we're in now a bull cycle here, a long-awaited bull cycle by a lot of that crowd. So for folks watching here, I mean, you know that I've got my conference that's going to be happening about a month before Brien's, a little over a month before Brien's. And let me just contrast the two real briefly. My conference is, really good for those people who, when you're listening from a speaker, you want to absorb everything that they're talking to you about. You want to take really good notes and share ideas with people, in the live chat that's going on that day. Fantastic event for all the reasons I've talked about in the past. But you can do that from the privacy of your home. You don't have to get on a plane. You don't have to go to a hotel and all that type of stuff, which is great for kind of absorption of that type of information. If you want that and the ability to interact with others, right? And again, not just the opportunity to go up to, say, a Rick Rule in the hallway and have a conversation with him and ask him that question that you finally got your moment, you get to shoot your shot, right? You get that opportunity all day long at this event. But then you also get a chance to really spend time with other investors like you who are just as passionate, just as interested, wrestling with the same questions you are. And you can have great conversations at your tables. You can go out to dinner together. New Orleans is a really fun place to go. And it's just great intellectual exchange. Brien, I had the real privilege last year. You always have me chair the Future of Money panel, which is great. And the faculty for that is very esteemed, and it's always a great conversation. But I got to step in and chair the panel for Matt Taibbi, Konstantin Kisin, and Dominic Frisby, really on like the future of freedom and freedoms in general and freedoms of speech specifically with those media specialists there. That was one of the most intellectually interesting and just completely fulfilling professional experiences I've had as an interviewer. So it's the creation of those type of experiences, plus that in-person element that you just can't get from an online-only conference. So if this interests you at all, highly recommend that you go to neworleansconference.com/TM1 and register for Brien's event.
And Adam, thank you for bringing your talents to my event, because you are the preeminent interviewer out there today, and you did such a fantastic job last year, and you do a fantastic job every year with your event. I am envious of your speaker roster, as I know you are sometimes of mine. So we both strive to achieve the same goals, and I think we're getting there. But man, I look at your event and it's just amazing what you do and who you get on your channel and on your event. It's just congratulations for doing such a fantastic job. I'm such an avid follower of yours, and I truly appreciate what you're doing for everyone.
Yeah, well, you are so kind, and look, people here get to hear me talk all the time, and I really want to just be as direct as I can be about the value that you and your team there are providing through your event there. So thank you for the very kind words. But folks, Brien is a silver-tongued Southern charmer, as I'm sure you've learned through the course of this interview. Not that I won't take the compliment, but this man is creating just a ton of exceptional value there that you obviously should go check out. All right, well, look, Brien, I normally ask the question, where should folks go to learn more about you and your work? But I think Gold Newsletter and the conference are the two big things in your space. Real quick, is there any sort of last word on either the conversation that we've had so far about the precious metals, or just anything about your overall outlook that you'd like to share with folks before we wrap up?
Yeah, I think for metals and miners, I think this is a generational opportunity. The last time I saw something like this was at the turn of the century, the early 2000s. But back then we were hopeful that the gold price and the silver price would reach new records. At least the gold price is there already, but the mining stocks have not. So if you are inclined to invest in, as you say, a much more volatile area, I think this is an opportunity that is staring us right in the face, and you should be positioned either for insurance or as an investment somehow.
All right, well said. And actually, I'm going to apologize. I'm going to put you on the spot for a minute here, and if you want me to cut this out in the editing, I will. But we won't say this is an endorsement, but just as sort of as a taste, as an appetizer, an amuse-bouche, if you will, to this audience about the types of companies that you cover in your newsletter. Is there a mining company right now that has your attention enough that you think is worth viewers who are interested in this space just go research after this discussion?
Yeah, I would say a recent recommendation, actually a recommendation in the last issue, and this is a company I do not own yet. And that's only because of a lack of available capital because I'm so invested in the sector. But there's a company called Meridian Gold that is developing a project, and the economics are absolutely extraordinary. They were extraordinary at a gold price $500 lower than where we are today. It's very well backed. It's got a great project with a lot of growth potential. That's Meridian Gold.
All right. Very much appreciate you sharing with that. Again, just wanted folks to have some specificity as to what to look forward to. So thank you for being willing to do that. Brien, my friend, it's always a pleasure. Can't wait to see you in November at your 50th anniversary conference. Thanks so much for giving us so much of your time and expertise today. I just very much value both your expertise and our friendship.
Thank you, Adam. Same here. And I'm looking forward to seeing you very shortly down here in New Orleans.
All right. Well, now's the time on the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. We bring them in to react to what the guests said and also talk about what the market's done over the past week. Guys, this week, I think that this is going to be like a slow pitch softball to you guys because Brien, spent a ton of time talking about the precious metals and gold and the opportunity he sees there. I know that you guys have had very similar outlooks to the promise for gold that Brien had and still has, and have positioned for it. So I think your portfolios have benefited pretty well this year from the action in both gold and the miners themselves. Obviously, you guys bring in some extra skill sets in there too, like hedging and whatnot. So anyways, I want to give you guys the floor. Mike, why don't I hand it to you, just because you've on many videos in the past this year have been walking us through your charts on gold and talked about the potential of breakouts that you thought was happening and the technical patterns, which of course then proved to be true. So what were some of your key takeaways from the discussion with Brien?
No, Brian's a great guy, and this is a topic that is near and dear to our heart. I always really love this topic, gold and real assets. Met Brien a number of times. John and I have been to the New Orleans Investment Conference a lot of times. Brien runs a great newsletter. He knows a lot of key players in the industry. He knows his stuff. And so I was really keen on listening to this. I'm going to try to encapsulate an hour-long interview in maybe 5 minutes or less for what I think were the high points for me. Brien said the Fed pivot is the immediate big event. People have been talking about this Fed pivot for more than a year, right? Well, it's finally happened, and it's a 50 basis point drop, and now the market expects another, maybe 1.5% over the next year. But the whole world is trying to adjust for this, and at the same time, Brien talked about we're at the end of 40 plus years of easy money. We're at the end of 40 plus years of this major bull cycle. This, basically bull market in bonds, bull market in stocks, interest rates going lower, all this never ending, ever easier money. And it really seems like the gold market's sniffing that out. The gold market's been basing out for a few years. And we've been talking about that on this program for dozens of different times. And we've finally broken out of this consolidation. And that has ramifications for miners and silver too, which we can talk about a little bit later. It's really bullish. This is really bullish for real things. And why? It's because Brien says we can't have positive real rates. If we have positive real rates, our $34 trillion in debt will sink us. It will cripple us. So we just can't have it. So that's the market knows that. And so the metals have been reacting to that for quite some time. Central banks are going to have their work cut out for them for the next bunch of years, maybe for even more, to keep real rates negative. And gold itself has had the best start for the year since 1970. Pretty amazing. By the way, Western investors have just started to get involved. Brien talked about GLD, the ETF GLD, as a proxy for Western markets. Well, Chinese buyers, Russian buyers, Asian buyers, they've been buying for a long time. But Western buyers really haven't jumped in until July. So it's only been the last few months. And Brien also talked about at the peak of prior gold markets, you've seen about 4% of institutional money in gold. And we're somewhere like below 1%. 1%. And so Brien says if we get back to prior bull market peaks, gold should be roughly around $6,000 an ounce. And it's almost $3,000. So I guess that's a doubling or a little bit more. And he talks about how silver could likely do a whole lot better than that. The next big stop for silver, because you guys talked about silver, we frankly think there's a lot more percentage upside into near to intermediate term in silver than in gold. Silver, which is presently around $32 an ounce, should be seeing its next stop around $35 an ounce relatively shortly. And then from there, it's 40-ish. And then the old all-time highs of 50. And Brien did some quick math that said if gold was at 6,000, we might see silver at 50 to 100. I think 100 would be more likely if gold was up at 6,000 myself. So a couple other quick things. Gold doesn't always crash in a stock market crash. A lot of our clients think that gold will crash if the stock market crashes because that's what happened in 2008, 2009. Well, that was yesterday's battle, right? If you look at a chart of 1973, 1974, if you look at a chart of the 1987 crash, granted the 1987 crash was kind of an isolated event, you'll see in the big downdrafts that those markets had, the gold went up, particularly 73, 74. Stocks lost nearly half their value and gold went up by nearly doubled. Now, of course, that was during an inflationary scare time, but still, don't take it as for granted that gold has to go down because the stock market goes down. A little bit more about silver as a monetary metal. Silver's got more industrial demand for solar and batteries and things like that. I think it seems like Brien is keen on silver because of the fact that it has more upside. We are too. Definitely is more risky, as you pointed out, Adam. You have to understand the risk, hedge if you can, talk to a financial professional that knows how to use options if you don't know how to do it. Lastly, he talked about opportunities in silver miners being even more potential opportunity than gold miners, and within that space, junior silver miners. Well, that's probably true, but our advice to people, I think, would be just get exposure to the sector. Don't worry about individual names. Don't worry about silver miners versus gold miners. We've got a static allocation to our portfolio at the moment. In fact, we just used last week's strength to rebalance to roughly 10% in most accounts, a model weight in gold mining stocks. These are gold mining major stocks. We've got an ETF in there to represent that. So just get some exposure. First, get some exposure to gold and silver. And he talked about different types of gold and silver, investment purposes and insurance purposes, that type of thing. And I think I'll take a break here and give you guys a chance to talk. But overall, it was jam-packed with all kinds of information. We are very aligned in how we view things, and we think that these markets are going a lot higher.
All right. Look, like I said, kudos to you, Mike. You've been helping us keep all of our eye on the ball here, in terms of, the potential that the precious metals had to get into breakout mode, like gold certainly has gotten into, and silver hopefully looks like it's getting into as well. And the miners might be beginning to get into too. One of the things you just mentioned there, which is as a precious metals investor, especially because they're volatile, particularly when they've made big gains in a relatively short period of time, you want to think about maybe hedging, some of the gains that you've enjoyed. And I don't want to get into the details of hedging here. We don't have time to do it justice. But I do want to know that I want to note that it's an important part of your strategy in investing in this space. I mean, you use hedges in the other parts of your portfolio too, but you've certainly been using it in your your precious metals related positions. And folks, if you're if you've heard the term hedging, but you don't exactly know what it means or how it works, the New Harbor guys here were kind enough months ago to film a video for us that walks through the basics of hedging positions using options. And again, this is using options as insurance, not as a speculative play, but as a way to protect against downside risk in your portfolio. And so if you want to watch that video, just go to thoughtfulmoney.com/hedging, and it'll answer most of your basic fundamental questions about what it is, how it works. The guys walk through different strategies in charts. They make it very easy for the regular person to understand. Before I move to John and off the topic of precious metals, Mike, anything you want to say about your guys' hedging strategy? Are you moving your hedges up given the fact that prices have moved so much for gold and the miners recently?
We haven't moved it up quite yet, Adam. We're hoping to get a little bit more of a move higher. If you look at GDX, which is an ETF that holds gold mining stocks, whenever we mention a product is not a recommendation, we just happen to be using it as a point of illustration. So any of you viewers can take a look at a chart of GDX, for instance, Van Eck gold miner stock ETF. So GDX is right around $41 a share. That's the level that we were looking for. We had just previously, not long ago, established a hedge or a collar on 50% of our position. A lot of our clients had a lot more than target weight GDX for one reason or another, or different gold mining stocks. A lot of our clients had 15, 18, 20, 25, 30% because they may have been in stocks, gold mining stocks for a long time. And a lot of those people still want to have over-concentrated positions. But for our main core model, a lot of people had, depending upon what time they bought in, they may have had double model weight. They may have come in a few years ago, put 10% in and had 20% now because these gold mining stocks have doubled. So we have to have targets based on resistance zones, based on chart patterns, that type of thing. So that for us was 41. So the first way to hedge is to trim your position.
Is to rebalance, yeah.
Exactly. So that's what we did. We rebalanced to 10% for most people, not all, and at that level of 41. But looking at these charts and thinking about these levels that Brien talked about, I don't know about 6,000 gold, but I think I see in the charts that 3,000 could happen, and maybe even this year. You know, and silver should be pulled up too. That should bring GDX up into the mid 40s. You know, and beyond that, it should be it shouldn't be that hard to get to the low 50s. So we'd like to walk it up there. We'd like to take that ride with it, but we've been disappointed in the past. A lot of your viewers and a lot of holders in gold and silver and miners have been disappointed in the past. So what we want to do is keep moving up our hedges. So the first thing we did was we rebalanced. Number one, we have a hedge at 45 on the ceiling and another one at 35 on the bottom right now on GDX. That's pretty wide. It's a 45-35 hedge. GDX is at 41. We'll see what happens in the next couple of weeks. This hedge expires in a couple of weeks. Hopefully we drift higher to 43, 44, even 45, and we can reset that hedge. Maybe we can reset that hedge again, roll it out another month, go to December, and this time do a 50/40, and just keep moving the ceiling up and the floor up. And we can even go more than 50% hedge. We can go 100% hedge. That's kind of how it looks like. I know I'm not illustrating it, I'm only describing it, but I wouldn't be surprised to see GDX go even higher than that in the coming years. And our job is to basically walk that up, but always keep some kind of control in place so that we have a plan. Most investors get into trouble because they have no plan. And believe me, we've learned over the years, we've learned all about emotion. We've learned all about mistakes in planning. We've learned it all. We've been in this business more than 25 years, and we're here to help people avoid those mistakes, avoid the emotional mistakes, avoid the number one mistake of not having a plan.
All right. John, coming over to you now, and maybe this to a certain extent relates to emotional territory, but I just want to note that there's been a lot that has changed lately on the global macroeconomic landscape. The Fed has now pivoted and now is actively cutting interest rates. ECB has already been out there even before the Fed cutting interest rates. And now China is firing its monetary and fiscal bazookas with gusto. So the world's major economies have all reverted back to easing cycles at this point in time. Markets have boosted in response to this. And an increasing number of the experts that I've had on this channel, the tenor has been much more decidedly bullish of late than what the average was, I would say, even a month ago. In many ways, it's because of this, coordinated global return to easing here. So, I think those that have a lot of concerns about the state of the American consumer, what may happen with the unemployment market over time, potential recessionary risks lurking out there. I don't think those have all gone away, but I think you can probably make a stronger argument now that the odds of a hard landing, at least in the near term, may now be lower than they were before this coordinated effort. What's your guys' take? And is that influencing at all how you guys are allocating capital right now?
Yeah, so we are definitely seeing that kind of change of sentiment, Adam, come through the things that we follow and read. To be clear, we're not economists. We certainly steep ourselves in the economic numbers and perspectives of many different people, but ultimately we're market technicians, and we kind of let markets guide us. With the thought that markets are kind of sometimes irrational, but oftentimes they are kind of speaking what the human mind can't necessarily process in promulgating a future. But yeah, we're definitely seeing that, and we're seeing it in our market indicators. As concerned as we are about we still are at record high valuations in the S&P 500, for example. There's only a couple times in history that have even rivaled this. So one has to be, any student of history has to take that as some level of concern. But we have a battery of different market indicators that we used to kind of use as a weight of the evidence kind of metric, if you will. And I've often used the analogy of a jigsaw puzzle. As a jigsaw puzzle starts to get completed, you start to see an emerging picture. And you don't need the full picture to be emerged to kind of get a sense for what the scene looks like, whether it's a good scene or a not so good scene. And the weight of the evidence of the indicators we look at across short, medium, and longer term market technicals are all very bullish right now. They're getting a little extended, which in its own way says we're due for a pullback. But yeah, so one of the puzzlements that I have and we have is the interest rate projections, both by the Fed and then what the market has taken as their view of what interest rates, short-term interest rates will likely be, are kind of at odds with that no landing kind of scenario. And we think there's a kind of a disappointment that's been baked into the cake here, that the bond market seems to be pricing one thing, the stock market seems to be pricing another, and both can't be right at the same time. And the takeaway, if in fact we are not due for a imminent or even severe recession, the likely scenario with this kind of interest rate outlook is probably things like stocks and real assets, commodities continue to do well, especially real assets and commodities like gold, like we just talked about. And frankly, probably bonds, longer term bonds, are what struggle. Not crash. I'm not talking about a crash, but this idea that they rally tremendously in that scenario, because we've got an election coming up. Consensus is that regardless of who wins, there's probably going to be more deficit spending and a lot of catalysts that could really cause bonds to kind of struggle. And I want to use that as a segue. So yeah, I agree that we see this in the market indicators that we look at, that despite concerns about recessions, that we're due for one, right? There's been uninversions of the yield curve. There's been all kinds of classic indicators that portend imminent recession. But we're not seeing it in the numbers yet, the market action and that kind of thing. So until we do, we're gonna kind of play it both ways. We're gonna be defensive, but also postured for further moves ahead, both in the stock market, but especially in the commodities market. If I could just kind of segue and bring it back to the gold market, one of the things that I want to just emphasize is that for far too long, I think our financial industry has made things like gold and precious metals seem like they're the territory of bunker-minded survivalists. They've been given a stigma that's not so positive. And yet we're seeing mainstream firms come out with price targets. Citigroup, for example, just came out with a year-end 2025, so a little over a year out, price target for silver of $40 an ounce. We're at 31 and change now. So that's a pretty good, even from a mainstream firm. I think Bank of America has got a $3,000 price target on gold. Right, so these aren't crazy things we're talking about. Whether we go 6,000 gold or not doesn't much matter. But the point I want to make is you don't need to have a large allocation. In fact, we don't advocate a huge allocation. We've got a target allocation of gold miners of 10% in our model portfolios. We advocate that folks like Brien talked about, gold having both kind of an insurance value but also an investment value. For the insurance piece, we advocate having some physical precious metals, 5 to 10% of your financial assets. We're not talking about 50 or 60 or 70%. And it doesn't take much to properly diversify a portfolio. And I'll just leave it with one chart here before we take a pause, just to kind of make the emphasis. This is an analysis that Bank of America did. And it basically shows, for most people, they think about investing as a mix of stocks and bonds. And more, one should ask themselves, well, what about if we mix it up here a little bit? And this is just a hypothetical study that BofA did, that said, well, instead of treasuries, let's look at a 60-40 portfolio, but using commodities instead of treasury bonds as kind of, hey, wouldn't this be a crazy idea? And this goes back, and you can see here the performance of that actually has been better. And there have been periods like for here, the 70s, you can see the gap here, because gold did great in the 70s. And so far in like the last year, the last couple of years, gold has done much better than treasuries. This is not any projection of guaranteed future, but just a chart to make the point that not only is gold not a thing of bunker-minded survival, it's a very prudent, gold and commodities in general, very prudent diversifier, especially in the kind of environment that we're in with the monetary policies and the fiscal situation that we're in. I think investors and their advisors doing themselves a great disservice if they don't think beyond the box of a traditional allocation.
Okay. And I just, hearing that comment plus something you said a few minutes ago about, positioning for the perhaps arising possibility that, equities, commodities, a number of different asset classes might perform well in the near term, given all this easing I was talking about. I just interviewed Jan Van Eck on this channel, and I know that you guys are followers and fans of Jan and his firm. Not only do you own several of the ETFs that his firm puts out there, but also I actually met Jan through an introduction through you guys. And Jan feels very similarly to kind of exactly that asset class rundown that you just gave there. He also thinks that commodities are going to do quite well. He had a slide showing the performance of asset classes this year. Gold's actually done great. The commodity complex itself has not done very well so far this year. And you marry that to other charts that I'm sure most of our viewers have seen here that show like the S&P to commodities ratio or the Dow to commodities ratio. And it's about as low as it's ever been historically right now. And I'm trying to remember who I was talking to the other day who said that they love they love extremes. They love when they see a chart that's at extremes. I think it was Jan actually. This was in regards to a different chart about a different extreme, but he's like, that just gives you a lot more confidence as a capital allocator that mean reversion is going to kick in to your benefit at some point in time, right? So for all the reasons we're talking about, as well as just the laws of math and reversion to the mean, commodities, you can make a pretty good argument that they deserve to have a place in a portfolio, not just from the time-honored reasons you mentioned, but given some of the current conditions that are outlying there today.
Yeah, those charts are great, and especially when they're extremes. But understand, and certainly you're not suggesting this, extreme charts can become even more extreme.
Absolutely,
it's one of the things that we've learned over the years and have been humbled so many times. So I think we think it's really important to talk not just about possibilities but probabilities, right? So we can talk about $6,000 gold, but let's put a probability on that. It's certainly not 100%, right? So I think the point of a lot of investors take an idea and a price scenario and things like that, and they become so centered on it that it clouds their vision. We're very careful to let the price action guide us and never get too confident, because there's always the probability that something we don't see comes. And it's, the extreme charts like you just talked about should serve to increase the probabilities of a reversion, but it's never 100%, right? There's always that scenario where it gets even more extreme.
I appreciate you mentioning that. And again, commodities, folks, are more volatile than your standard asset classes. Secondly, John's point, the market can remain irrational for a lot longer than you can remain solvent. There's that old saw, right? So just because it's extreme doesn't mean it can't become more extreme. And this then gets to, I think, why you guys are such good practitioners of hedging, right? Which is to have the humility and the sensibleness to say, hey, we're making a bet here, but we want to make sure that we put some safeguards in place in case the bet doesn't go the way we think it's going to go.
Yeah, we have tail risk hedges on the S&P. As bullish as our short-term indicators are, we do have out-of-the-money put options and they're cheap because it is a low probability event, but nonetheless, we have them on the portfolio right now.
All right. Well, look, we're going to have to start wrapping it up there then. Folks, if you enjoyed this conversation with Brien, would like to have him come back on the program whenever his crystal ball on gold and the precious metals is telling him something new. Let us know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you'd like help in potentially putting anything that was discussed today in practice in your portfolio, unless you've got a really successful track record of doing that yourself as a DIY investor, most people would likely benefit from the guidance of a good professional financial advisor. So if you'd like to benefit from that, feel free to schedule a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. The companies will be in touch with you right away. As a reminder, these consultations are totally free. There's no strings attached. There's no commitment involved. It's just a free public service that these firms offer. John and Mike, thank you for offering those free consultations. Thank you for giving so much of your time today. Congratulations on what I believe must have been a pretty strong quarter for you guys, given, amongst other things, the performance of the precious metals. Look forward to having you guys back on here next week.
Thanks for the kind words, Adam, and thank you everyone for watching.
Yeah, we'll see you next week, Adam. Always a pleasure, and things are keeping us very, very engaged and excited these days. Lots of things going on.
All right. Well, no matter what goes on, we'll have you guys here making sense of it for us next week. Thanks in advance for that, and everybody else, thanks so much for watching.